So all of your hard work that I was mentioning earlier had to do with all that analysis of analyzing a transaction. So your learning objective one and your learning objective two were all about analyzing transactions. What accounts were affected, how were they affected, more in it or less in it, and then the debit and credit analysis on top of that. Well, if it's affected on the left side, that's the debit side. Affected on the right side of the account, that's the credit side. So a lot of the analysis went down early, and we spent a lot of time on that last week. Then you got introduced to the journal, which is basically applying all that analysis and simply writing it down in the order that they happened. And so you were introduced to the journal and you started entering data. This is basically where accounting physically starts, in the journal. That's how the bookkeeping cycle actually starts. You start writing stuff in the journal. What happens to the data once it's in the journal is it gets posted into its specific account in the ledger, and that's what you're going to be learning about today. This is learning objective 4, is what happens to all that data after we put it in the journal. Okay, so it's going to be moved on. So we're going to be focusing in on this today. Okay, so learning objective 4 starts here. Okay. So the ledger basically is, the journal is where everything gets put in terms of the data. And then it gets sort of collected in the accounts in the ledger. So for example, we're putting a lot of information in the journal. You might debit cash and credit common stock. You might debit rent expense and credit cash. You might be doing all that types of stuff in the journal. What happens to all those numbers as they hit those accounts? Well, they sort of get compiled individually in the journal. So we're going to be focused, I'm saying, in the ledger from the journal. So you're going to be seeing how that works, okay, today. So the ledger is actually, back in the day, it was this enormous book. Because in that book were all of the accounts of that business. Each account had its own section in that book. So you can open up to a specific account and see all the activity in that account for that business. All of those numbers came from the journal. The ledger simply is that very, very large book of accounts to show sort of a summary of what happened. The ledger has a very specific order to it. Asset accounts are listed first. And of course, they're going to be listed in the order that they would show up on a balance sheet, classified balance sheet. So as you know, when you look at a classified balance sheet, at the asset section, cash is always the first account that's listed. So if you opened up a ledger, the very first part of the ledger is dedicated to cash and the cash account. Everything that happened in the cash account is going to be compiled right there in the ledger. It's almost like having a separate chapter in a book for each of these accounts. Chapter 1, in essence, that first section would be simply cash and everything that happened to cash. You would turn to the next section or the next chapter, and the next asset account would be listed. And then again, and everything happened to that account would show up in the ledger. Then you would look at the next account and so forth and so on. So they would be sort of listed in this sort of pecking order that's based on the classified balance sheet. After the asset accounts are listed, the next set of accounts you'll see in the ledger will be the liability accounts. Again, they're going to be ordered according to how you would see them on the classified balance sheet. And so you'll start with, the notes payable, the accounts payable, things like this. Each of these would have its own separate section in the ledger, and only the information about that account would be listed there. So everything that happened to a notes payable would be in this section of the ledger. only talking about notes payable and what happened to notes payable. The next section of the ledger would show everything that's happening with accounts payable. And this is a history, so everything that ever happened is going to be shown in the ledger. It's a pretty large book, okay? The next set of accounts that you'd see in the ledger after the liability accounts are listed would be the stockholders' equity accounts in the order you would see here. Common stock would have its own section, and everything that happened to common stock account would be there. Then the retained earnings section would be listed. Dividends is the next account that's listed in the ledger after retained earnings. Okay, that's the only thing that's a little bit different about the ledger, is that's where dividends would be. Then you'd see your revenue accounts. In our case with Sierra Corporation, they only have one revenue account, but like I said, a lot of companies have more than one revenue account. So you'd have a section for each individual revenue account in the ledger, and if you looked at it, that would all the activity for that account would be listed there. And then all your expense accounts would have their each individual section in the ledger, and everything that ever happened to it would be showing there. Where do the numbers come from that get put in here? So when I look at cash account, for example, and I see all those numbers, where do all those numbers come from? They come from the journal. Okay. So whatever happens in the journal is going to get transferred to the specific accounts in the ledger. Okay, and you'll see that happen, and you'll be doing it today. In order for any business to exist, in order to do accounting, and I think that was one of the questions you had earlier about, well, I don't know what account to debit or credit here. Well, that's because that when you start a business, you're supposed to have a record of all your accounts. That's a chart of accounts, okay? And so even if you were to start a business today, in order for you to actually do accounting on your business, you would need to identify what accounts your business had. You'd have to put together a chart of accounts. What you see here is a chart of accounts for Sierra Corporation in our book. They have the following asset accounts. They have the following liability accounts. These are the stockholders' equity accounts. They only have one revenue account, and they have a whole bunch of individual expense accounts that are listed here. But this is this listing of accounts is where we go to do our journaling, to do our analysis of a transaction, right? That's how we know we debit cash and credit common stock. Well, because we have to know those accounts exist first. And in order to do that, you have to build a chart of accounts before you can do accounting. Again, that root word of accounting, it's about the accounts. No accounts, no accounting. So you have to put together that chart of accounts in order to do accounting. So posting happens when we transfer the information from the journal into the specific account in the ledger. And here is the first part. Here is the actual part of the journal where we did the entry for October the 1st for Sierra Corporation. We debited the cash account 10,000. We credited common stock 10,000 in the journal. Okay. So again, now that you actually put the data in the journal, we have to transfer the individual data in the individual accounts to their appropriate ledger accounts. So like I said here, the very first thing we did was debit cash $10,000. Posting means we're going to duplicate that by transferring the debit to the individual cash account in the ledger. So in this way, we know exactly what happened to cash. It's transferred from the journal into the ledger. The reason we have to do the transfer into the ledger is because the ledger is where we go to find the balances in all the accounts. We don't go and analyze all the journal entries. It'll take us all day. They're just simply posted into the individual ledger accounts. So when we need to know how much cash we have in the business, we simply look at the ledger. Okay. You'll notice that there's a fifth column in called a reference column. You're not going to see this in any of your homework, but it is shown in your book, and it is a common point in accounting software and in accounting prior to having software when I was doing it. Here, the reference for this entry into the cash ledger comes from J1, which is simply the journal page 1. So it's just the reference is where it came from and the page number, journal page 1. The reference in the journal here for cash is the actual account number of cash in the ledger. All the accounts will have account numbers. Assets are usually account numbers starting with a 1. Liabilities are account numbers starting with a 2. Stockholders' equity accounts are account numbers starting with a 3. Revenues usually start with a 4 and expenses usually start with a 5. So you'll see that every single account will have a specific account number. And this is the appropriate reference to use on a journal. So common stock, we haven't seen this posted, but very likely common stock would have a reference account number of 301 because common stock is a stockholders equity account, which is the third set of accounts, and it's the first one. So 301, just like cash is the first asset, 101. I would guess that common stock for this company would be account number 301. Again, you don't have to know this because it's just a point of reference, literally, no pun intended. So you understand it. But it's basically about transferring the data from the journal to their individual accounts in the ledger. We would do the same thing for common stock in the common stock account in the ledger. So let's follow the process. And it is illustrated in your book. It's illustrated on Wiley. It's very good to sort of know how far you've actually come. Look at, and these 11 events came from the first objective that we've been analyzing. Look at how much analysis we did. This first event, when stockholders invest 10,000 cash for common stock, right? And so look at all the analysis, right? What accounts are affected? How are they affected? And then the debit and credit analysis for each of those accounts. This is all learning objective 1 and learning objective 2 stuff that we spent all that time doing last week. And that's because this is critically important to get the analysis done. Learning objective 3 basically is, okay, now that you know how to do that, put it in the journal. And so the journal entry shows here as the date of October the 1st, a debit of $10,000 to cash, a credit of $10,000 to common stock. That, excuse me, that was learning objective 3. Learning objective 4 is now that we have that journal entry, we need to post those, transfer the numbers into the individual accounts. Look at these as sort of separate pages in the ledger. The cash would have its own section. The common stock account would have its own section in the ledger. It's just side by side here because the slide's only so big, right? Gonna put a lot of information on a small slide here. So this $10,000 debit to cash, remember it's in the debit column, there's only 2 columns, would be transferred to the cash account on the debit side. Notice again, the accounts there's 2 sides to the account. So if this is posted on the debit side of the journal, it's going to be posted on the debit side of the account in the ledger. Conversely, common stock has a credit of 10,000. So when we look at the common stock account, again, it's shaped in this T to show that the account has 2 sides, a debit and a credit side. Because this is on the credit side of the journal, it's going to be put in the credit side of the account on the ledger. That's posting. That's posting. Thank God all of this stuff is electronically done for us in doing accounting. But if you don't know how it's done, you're not going to know how the software works. And that's important to know. You can't pick on any errors either. Here's the second event where they borrowed cash for a note payable, right? Look at all the analysis we did, right? What accounts were affected? How were they affected more or less in the account? And then the debit and credit analysis for each of these accounts had to happen. All of that was objective 1 and 2. Then what we've been working on now is the journal entry. Now that you know how to do it, we're writing it in the journal. This is the very, very first place accounting actually happens, is the journal, because it's the first place it's written down. So on October the 1st, we have a debit of 5,000 to cash, credit of 5,000 to notes payable. Okay. So now that it's in the journal, what happens? Well, we have to post it into the individual accounts. Again, this is sort of two separate sections of the ledger. Think about this as sort of like the first chapter in a book, and this is a little bit later in the book, its own chapter, right? So again, we have a debit of 5,000 to cash that has to be posted for October the 1st. So this is what happens here. We post it for October the 1st, another $5,000. It doesn't negate the other event. That 10,000 was already there. We're adding another 5,000. In other words, a debit to cash means more, right? So you would look at the cash account now and say, okay, cash has $15,000 debit balance because there's $15,000 on the debit side and nothing on the credit side. So the balance is 15,000 debit. This credit to notes payable, again, needs to be posted in the notes payable account on the credit side of the account. Again, every account has two sides, the debit and credit side. This is going on the credit side. Note payable is a liability. Credits to liability accounts means we have more of that liability. Okay. Event number 3 is when they used cash to buy equipment. Look at all that analysis we did. What accounts were affected, how were they affected, and then we apply debit and credit analysis to show we had a debit to equipment and a credit to cash. So we wrote it down in the journal. October the 2nd, a debit to equipment for 5,000, a credit to cash for 5,000. What happens next is they have to be transferred into their individual pages. Again, think about these as individual pages in a book. This is one section of it, this is another. So this $5,000 debit to equipment shows up on the debit side of the equipment account, showing we have more equipment. This $5,000 credit to cash is going to be posted on the credit side of the cash account. So if someone asked you now, how much cash do we have? What's the balance in cash? Well, you'd have to add your debits and subtract your credits. And you notice that the bigger side, the debit side, would be $10,000 larger. So cash would have a $10,000 debit balance. Okay, that's how we would read it in accounting. And that's important to know how to read your balances in the account. Equipment would simply have a $5,000 debit balance because there's nothing else going on with equipment. But cash is very busy, right? It has postings on its debit and credit side. So figuring out what the balance is, particularly of active accounts like cash, is going to be something you need to know how to do. But again, you're simply adding the debit side together, taking away the credit side amount. The balance is going to be on the debit side. The debit side's larger than the credit side. So that's where the balance is. Here on the 4th event, we received money, cash advance from a client. We did some transaction analysis. Yes, we definitely have more cash, and we definitely now owe this person a bunch of tours. So that's unearned service revenue. Remember, unearned because you owe the work. Okay. Did our debit and credit analysis for that. More cash is on the debit side. More unearned service revenue is on the credit side. So we did our journal entry. A debit to cash, credit to unearned service revenue. After the journal entry is done, where do those numbers go? They get posted into their individual accounts. Again, this is like two separate pages and two separate sections of the ledger. This $1,200 debit would be posted to the cash account here on the debit side of the cash account. It's got to match. This $1,200 credit to unearned service revenue needs to be posted on the credit side of unearned service revenue. Again, they got to match. Okay. So now what's the balance in cash? Well, the balance in cash would be $11,200 debit balance in cash, because the debit side is larger than the credit side by $11,200. the balance would be on the left side of the debit side. Remember, assets have normal balances on the debit side of the account because that's the side it increases. Got to understand those terms from Learning Objective 2. Make sure you know those. Event number 5 here, we received money for services provided. So again, this is once you do the work, it's service revenue because the work has been done. The other, if you remember from the previous example, we had unearned service revenue. The word unearned means you owe it. If you've already done the work, you don't owe it. So it's service revenue. That's the difference between those accounts that you have to know. So we have more service revenue, we have more cash. We did our debit and credit analysis. So a debit to cash, credit to service revenue, we wrote it down in the journal. On the 3rd of October, we have a debit to cash and a credit to service revenue. What happens to those numbers after? They get posted into their individual, again, this is like 2 different chapters in a big book, individual accounts. So this $10,000 debit will go on the debit side of the cash account. This $10,000 credit goes on the credit side of the revenue account. Again, all accounts have 2 sides. Please make sure you're matching them up when you post. That's it. What's the balance in cash now? Well, the debit side is much larger, right? By $21,200. So it's a $21,200 debit balance in cash. Okay. The 6th event is we paid rent for the month of October. We analyzed it. We said, okay, we had rent as an expense. Every time we have expenses, retained earnings or stockholders' equity goes down. So less stockholders' equity with more expenses, less cash. We did our debit and credit analysis. We debit the rent expense. Again, name the expenses what it is, and we credit cash. So we wrote it down in the journal for the 3rd of October, rent expense, $900 debit, cash, $900 credit. They have to be posted to the proper sides on their account. So much later on in this very, very large book that we call the ledger, you would see the rent expense account, and this debit has to be posted to the rent expense account on the debit side. Right. However, we see that this $900 credit to cash, so we would go ahead and put that $900 on the credit side of the cash account, okay, which signifies less cash. The 7th event here, look at all the analysis we did. We bought an insurance policy for a year, and we said, okay, that's prepaid insurance. We have more prepaid insurance and less cash. We did our debit and credit analysis. More prepaid insurance happens on the debit side, less cash happens on the credit side of its account. So we wrote it down in the journal, a debit to prepaid insurance, a credit to cash. What happens to these numbers after they go to the journal? They get posted to their individual accounts. Again, it's like looking at 2 separate chapters in a very large book. The cash account and the prepaid insurance account are separate. So this debit to prepaid insurance would go on the debit side of its account. This credit to cash would go on the credit side of the cash account. The 8th event, we bought supplies on account. We learned that little phrase on account means when we buy something, we're going to pay later. So we analyzed it. We said, okay, we got more supplies, but now we got more bills, more accounts payable. We did our debit and credit analysis. More supplies is on the debit side, more accounts payables on the credit side. So we wrote it down, a debit to supplies for $2,500, a credit to accounts payable for $2,500. What happens to those numbers after that? They get posted to their individual accounts. Again, looking at 2 sort of separate chapters in a big book, for example. When you open up the supplies part, this debit to supplies needs to be on the debit side of the supplies account. Remember, all accounts have 2 sides. Make sure you're matching up. The credit to accounts payable goes on the credit side of the accounts payable account. The 9th event is not an event because when you hire someone, when you interview someone, it's just, you don't pay them up front. So there's no financial event to record that day. There will be when you pay them, but that didn't happen that day. The 10th event, we paid a dividend, $500, did a lot of analysis. Okay, dividends take away from retained earnings. Yeah, we have less cash. We did our debit and credit analysis on that. So dividends are on the debit side because they reduce equity. This less cash is on the credit side. So we wrote it down in the journal. A debit to dividends for $500, a credit to cash for $500. After that, they need to be posted to their individual accounts. Again, you're looking at two very separate sections of a very large book. Debit to dividends needs to go on the debit side of the dividends account. Credit to cash goes on the credit side of the cash account. And the very last event we looked at here, we paid those employees. We did some analysis on that. Okay, when you pay employees, that's a salaries and wages expense, and you pay them in cash. We did our debit and credit analysis. We know that expenses are on the debit side, and we have to name the expense what it is. So a debit to salaries and wages expense, and cash lowers on the credit side, so credit to cash. We wrote it in the journal as such, and then we post it to the individual accounts in the ledger. This debit to salaries and wages expense goes on the debit side of the expense account. The credit to cash goes here. Now, you might be asked, this is all 11 events. You're going to be asked, what's the balance in these accounts? Well, for the cash account, the balance is always going to be on the debit side. And when you add up all your debits and take away all your credits, I think it's going to be something like a $15,200 debit balance in the cash account. It's going to be on the debit side. Okay. This is what the journal looks like, right? Of all that stuff we did, this is what the journal looks like for all the transactions in October. It's a couple of slides long here, all the way down to that. That's all the journal. When you post it into the ledger, and if you take a look at the ledger on a bigger scale, each of these would be separate pages in the ledger, so you wouldn't see them all on one page like this. But again, this is a slideshow, so they got to put it all on one slide. So when you look at the cash account, you'll notice the balance in the cash account is $15,200 debit balance. Again, there's two sides to the account. The balance has to be on one side or the other. For assets, it's debit balances. All the asset accounts, as you see here, have debit side balances. Okay, so each account would have its own balance. Notes payable, accounts payable, unearned service revenue, liability accounts have their balances normally on the credit side of the account. So you'll see all of these as credit balances. Common stock would have its balance on the credit side, but dividends, which takes away from retained earnings, right, would be on the debit side. So the balance in the dividends account would be on the debit side. Service revenue is where all the profits are for the company after the expenses are removed. So that's going to show up on the credit side. Revenue is on the credit side of an account. And your individual expenses, as you see, show up on the debit side. Okay. So this is very, very important to know. Again, this would be like turning the page of a book. The cash account would be all alone. If you wanted to know what the balance in the cash account is, you'd open up the ledger to the cash account, look at the balance. That's the balance that we use for the balance sheet, for example, when you find out how much cash there is. That's the balance. This is where the balance comes from on all these accounts. Okay. So the do it exercise for objective 4 is this practice in posting. Okay. And you're posting from the journal, which is this section here, to individual accounts in the ledger, which of course they bunch up here. And this is how you want to approach it. Notice that what's really important, the dates have to be noted. Clearly, you need to know what account is being affected and whether the amount is on the debit or credit side of an account. So how you would look at this is July 1st, cash debit of 30,000. You would write this down. And again, I can't write really well, but July 1st, and then I would put $30,000 on the debit side of the cash account because that's how it matches. Debit here in the journal, debit side of the cash account. Common stock has a $30,000 credit. I go to common stock. I'll put the date in, 7/1, so it matches up. And my $30,000 here. And again, it's hard for me to write with my finger. I apologize. But so this has been transferred. In other words, posted. On the 9th, accounts receivable has a $6,000 debit to it. Here's the accounts receivable account. So on the 9th of July, I have a $6,000 debit I have to record in the accounts receivable account. I also have a $6,000 credit in service revenue. So I'll put the date in, my 7/9, and then the $6,000 credit to revenue, and I'm done with that, posting that. The cash account on the 24th got another $4,000 debit. So I'll put the date, 7/24, and I'll put my $4,000 debit in here. And then I have a $4,000 credit to accounts receivable on that same day. So 7/24 is my date, and my $4,000 credit would show up on this side. And I'm done posting. Now, in addition to posting, you're going to be asked what the balances are in the accounts. So what's the balance in the cash account? Well, you add these two together because they're on the debit side. This is a $34,000 debit balance in the cash account. What's the balance in accounts receivable? Well, accounts receivable is an asset account. Asset accounts have normal balances on the left side or the debit side. So 6,000 of debits matched with 4,000 of credits means the debit side is larger by $2,000. So the balance in accounts receivable is a $2,000 debit balance. Then, of course, common stock would have its credit balance of 30,000, service revenue credit balance of 6,000. And that's basically how you would do this. Questions on that?